Welcome to today's session for the Affordable Care Act update. There is my contact information. Like Amy said, if we run out of time at the end of the seminar and you do have questions that weren't able to be answered, go ahead and submit those and I'll email the answers back to you. I'm hoping to leave about 10 minutes at the end of the session, so start writing your questions down and let's see if we can get them answered. So these are our learning objectives for today. All of these are ACA terms that hopefully everybody is familiar with. We will touch on most of them throughout the presentation. Most of these terms should be a review for you once we get past the new updates. So good news, last Monday, being about a little over a week ago, we did get an extension on the forms. So the forms are now due to employees on March 2nd instead of January 31st. So that's good news. If you feel this extension should be in it, there is a spot at the end of the notice. It's on the last page of the notice where you can write in and request that with the IRS. I know several of us accountants are going to be doing that, so hopefully this extension could be a permanent fix. And unless it is, you're going to have to watch for that, and usually it comes out this time every year. Now, interestingly, that extension, there's a couple new things we'll talk about in a minute, but that extension, it does not extend the filing due date to the IRS. So if you're paper filing those forms to the IRS, your deadline is still February 28th. Keep in mind, it's not the last day of February, so it won't be February 29th this year. It will remain at February 28th. If you're electronically filing, those forms need to be filed by March 31st. Now we have seen, this past year, we've seen several, there are 972 CG notices coming from the IRS. Some of them are correct and some of them are incorrect. And what that notice is saying is it's saying, hey, your forms were received late. Now, some of those, like I said, are incorrect and they were actually filed on time. But just to maybe try and avoid that notice, I would suggest backing up that deadline a week and file those forms a week before they're due, whether it's paper file or e-filed, and keep track of how they're being filed. Keep a record of that. If you're going to paper file them, I would suggest doing it via certified mail, something where you actually have a receipt where you're getting confirmation that it was mailed to the IRS on that specific date. So in the notice, what is new for this year is, if any of you read through it, you'll see that there's some relief out there for health insurance issuers. So those would be the big insurance companies that are having those fully insured plans for our employers, or they could be the small employers that are filing those 1095B forms because they have a self-funded plan. Now, what that relief says is that relief says you still have to file those forms with the IRS. Nothing has changed there. But if you would prefer, you can put a notice out on your website, and so that your employees or your recipients would know that you will mail them a copy of their 1095B form if they request it. So if you choose to do this, you have to put a notice on your website. You have to put the physical address as well as an email address, as well as a phone number, so a contact name and phone number for someone that the employee or the recipient can contact should they wish to have a copy of that 1095B form. In my opinion, that relief is a bit worthless unless you're a very large insurance company, right? So if I have a self-funded plan, I'm a small employer, and I have 40 employees that I need to give this 1095B to, I can either send those forms out to each employee and pay the $20 in postage, or I'm going to have to put this notice with the correct information on my website, and then if those employees contact me, I have 30 days to get that form out to them. Again, my opinion, unless you've got a million forms out there and you're going to save $500,000 in postage, I would just ignore that relief, so to speak. You have to file those forms with the IRS. Nothing has changed there. So you already have to get them prepared. Also with this extension, we did get an extension of that good faith reporting. Now, what's new is if you've gone through the final instructions to the 1095C form, which actually came out, I believe it was yesterday, they say that that good faith effort, if you can show you made a good faith effort and didn't file them timely, that would cover it. I wouldn't go that far. I think the good faith effort should be used if I file a form and I file it incorrectly. That should be the good faith effort. You're going to want to get those filed on time with the IRS because what you think a good faith effort is might not be what the IRS thinks a good faith effort is. So some ACA updates, still talking about the repeal of that Cadillac tax. Obviously, it has bipartisan support, but not support of everyone. They need that funding to fund the ACA. That's why the economists out there are not in favor of it. Decision yet on that Texas versus United States, still in appeals with the Fifth Circuit Court. Interestingly, some states are now requiring individuals to have minimum essential coverage. We'll talk about those states in a minute. I anticipate more states will come to the table in the future years now that we don't have a federal mandate, and that's on the individual side. So again, that individual mandate is gone for your federal return. That doesn't affect the employer mandate as far as the 1094 and 1095C forms. Everything is still the same there. You still have the same filing requirement, and you're still required to put that information in if you're self-funded as far as which employee had coverage and whether their spouse or dependents had coverage and which months. So again, that's still required. I know there was some talk out there about whether that will be required now that we don't have the individual mandate, but yes, it is still required. Not having the federal mandate could potentially mean we'll have lower pay or play penalties. Remember, those are the penalties if we don't offer affordable and adequate insurance to our full-time employees and we are an applicable large employer. Now, why I say we could potentially have less penalties is because, remember, if individuals aren't mandated to have insurance, we may see less individuals or fewer individuals go to the exchange and qualify for a premium tax credit. Remember, qualifying for that premium tax credit, that is what triggers the pay or play penalties under the ACA. So if all of my employees, if I didn't offer insurance to any of my employees and I'm a large employer and none of those employees went to the exchange and qualified for a premium tax credit, I would never receive a pay or play penalty. Let's talk a little bit about those states. So this year we had New Jersey as well as Washington, D.C. They're now having their own individual mandate. How that affects you is if you have an employee that is working in that state, you'll have a filing requirement if you're an ALE in that state. If you don't have any in that state, any employees in that state, you're good for this year. Remember, Massachusetts started this prior to 19. So, and then in 2020, we have California, Rhode Island, and Vermont coming to the table. So far, Vermont's individual mandate is 0. So we'll see if they change that. Not all the rules have been released on these new states, but there are some other states contemplating this mandate. So again, how that affects you is if you have an employee in one of those states, you're going to have to watch to see if you have any reporting. I'm anticipating what will happen is if you have a self-funded plan, that's your code section 6055 reporting, you potentially could have a reporting to that state so that they can see who all had coverage. Reimbursement of medical premiums. I'm hoping that sometime I can stop putting this slide in there. Maybe once 2020 hits, we'll talk about that in a minute. I see this being done all too often. There is a huge penalty that is associated with reimbursing for medical premiums. So if you reimburse someone for a medical premium and you don't have what's called a QSARA, that's a qualified small employer health reimbursement account, and those are fairly new, so I see those few and far between. Or starting in 2020, if you have an individual coverage HRA. If you have one of those, then that's a different story. But assuming that you don't have either one of those and you're reimbursing for individual premiums, you actually are at risk for a $100 per day per person penalty. So you'd have a $36,500 penalty for all the employees that you're doing this for. Obviously, if you're a for-profit industry, then you would worry about that being the deductibility of a penalty as well. So here is some guidance. I know earlier this week I just talked to another employer and they said, well, we're reimbursing for premiums, but we're doing it post-tax. Well, if we read through this notice 2013-54, which came out on Friday the 13th, back in September of 2013. That's what kind of got the whole ball rolling, if you will. Then November 6th of 2014, the DOL, in conjunction with IRS and Treasury, released an FAQ and said, we don't care if it's pre-tax or post-tax, wrong is wrong and you'll have the penalty. So again, whether it's pre-tax or post-tax, don't be reimbursing any individuals for their individual coverage. Now, if you are part of an S corporation and you have a 2% shareholder, rules are different for those 2% shareholders. Or if you have the QSARAs or the ICHRAs that we had mentioned earlier, rules are different there as well. There is a caveat, because there can't be a rule without a caveat, right? So if you have this health reimbursement arrangement and you have fewer than 2 employees, in other words, you have 1 employee, then that is allowed, because the market reforms only pertain to plans with 2 or more employees. You could have an HRA that's integrated with a group plan, that is allowed, or your HRAs that are just for HIPAA accepted benefits. Remember, even if you have an HRA, you still need to pass the 105H non-discrimination rules. So those rules, if you do it for premiums only, they're not applicable at this time. So you could potentially have a 1-person HRA for your highly compensated individual, as long as it's only for their premiums and no medical expenses. So we are up to our polling question number 1 already. So employers still cannot reimburse for individual health insurance premiums except for plans with less than 2 employees unless they have a QSARA, or starting on January 1st of 2020, they have an ICHRA account. So correct, employers still cannot reimburse for individual health insurance premiums. Again, I see this being done way too often. I even see it being put on paychecks. You're not going to want to have that done, as you do have that $36,500 penalty per person you're doing that for per year. So let's talk a little bit about these new ICHRAs. So, you know, at first glance, I really don't know that they're all that people thought they would be, so to speak. There's a time and a place for them. There's a lot of rules that surround the ICHRAs. So if you do set up one of these ICHRAs, and they're first coming out in 2020, so you've never been able to have them before. Like I said, there's a lot of rules that go with this. Your plan document has to be drafted correctly, so I would make sure you have an ACA attorney draft that plan. There's attestation statements that have to go out to your employees. We'll talk about that in a minute. So what is happening here is, what you can do is you can set up these ICHRAs, and you can set them up as of 1/1/20. However, if you're going to set them up, you need to give a notice to your employees 90 days before the start date. So right now you can't set one up for January 1st, obviously, because you don't have 90 days before then to let your employees know that you're going to start offering these. Now, these ICHRAs can be used for both your medical premiums and your expenses, and any size employer is eligible. Remember, with the QSARAs, we're not going to really touch on those on this presentation, because those have been out since 2016. I believe they came out in December of 16. Those have been around for a while. But the bummer with the QSARAs were that they were only allowed for small employers, whereas these ICHRAs can be used by both large employers and small employers. Your participant or your employee must have individual coverage in order to accept this ICHRA. So they're going to, how it works is, if you want to put an ICHRA out there, let's say that you can't find a group plan that your employees that they want, or that's affordable to you to have. So you want to give your employees a benefit. So you're going to set up this ICHRA, and then they can pull monies out of this ICHRA account. They can either pull it all out at the beginning of the year, or you can put in your plan document that only so much money is available. Let's say like $100 a month that they can pull out at that time. Those employees then have to sign an annual attestation statement saying, yes, I have individual coverage before they can have that ICHRA. And we'll talk about this a little bit later, but then once they want those funds back from the employer, they have to send in a second statement saying, here is my expenses for January, let's say, and I'm attesting that I actually did have coverage in January. So group coverage isn't counted, TRICARE is not counted. Neither are healthcare sharing ministries. Remember, those healthcare sharing ministries were kind of the up and coming thing when the individual shared responsibility penalty was there. It was a way for individuals to have a sort of insurance and get out of that individual mandate. You can offer a group plan. If you're an employer, you can offer a group plan and the ICHRA to the same group of employees. You can have separate groups. We'll talk about that in a minute. And you can offer one group the ICHRA and one group a group plan. For example, I could have all of my salaried individuals have a group plan, and I could offer the ICHRA to all of my hourly employees. No limit on contributions, so that is different from the QSARAs. Remember the QSARAs, if I had a single plan, that contribution was roughly $5,000 that I could put in there, and if it was a family plan, I could put up to $10,200, I believe it was, in that account. So ICHRAs are nice in that I'm not limited there. My controlled groups rules do not apply, so if I have a related entity, we don't need to do the same thing. The employer again decides the contribution amount. You can vary that depending on your class of employees, but all employees in that same class need to be offered the same dollar amount. You can vary those amounts though based on the employee's age. Max is a 3-to-1 ratio, however. You can also vary those contribution amounts by the number of dependents. Again, it's funded only with employer dollars, so you can't put employee funds in there. Excuse me. So unlike the QSARA, you could offer an FSA as well. Individual plans that are purchased outside of the exchange, you can have those, the rest of the dollars for those premiums pre-taxed if your plan document allows it. But if you have an employee that goes to the exchange and gets an individual policy off the exchange, and the ICHRA was not enough dollars to fund that amount, any remaining amount that the employee has to pay out of their pocket, that can't run through a cafeteria plan. So here are the different classes of employees. We have quite a few. Again, we could use full-time and part-time employees and have 2 different classes, offer group plan to one and an ICHRA to another. Or we could do salaried and non-salaried. That's what I would anticipate we would see the most of. You should be aware, though, that if you decide to offer group insurance to one class and an ICHRA to another class, and those classes are either salaried versus non-salaried, part-time versus full-time, or people in different geographic locations, now you have to have a minimum threshold in that of employees in that ICHRA. So if I had less than 100 employees, I need to at least have 10 people in that category wherever the ICHRA is going to be offered. So be cognizant of that. We had already mentioned you need to give the employees a notice 90 days out. So I've got some people that are doing the ICHRAs as of January 1st. Some people didn't get on board with getting the notice out in time, so they're starting theirs on February 1st. I've got another employer who's putting theirs in as of April 1st. Now, all of the employers that I've worked with are doing it for various reasons. Some of them are doing it because the ICHRA will actually get you out of the employer mandate. So I've had groups that haven't been able to get an affordable group plan, so they've chosen to do an ICHRA account. I've had groups that say, you know what, I don't think any of my employees would want group insurance, they want their individual coverage, so they do an ICHRA account. And some of the employers are just on the fence. They don't know whether to do a group or individual coverage for their employees, so they're going to do the ICHRA and see where it pans out. So all of the above are reasons why people are doing the ICHRA. They're a good tool, in my opinion, if you do not have any benefits currently and you want to start offering a benefit to your employee, maybe to get more employees to stay with you or to entice people to come and work for you. Or let's say that you've been getting a large pay or play penalty via Notice 226J, and you want to curb that penalty. You could offer an ICHRA. It's a perfect reason to do it for that. Outside of those reasons, if you have a group plan that your employees are happy with and it's affordable to your company, I don't see any of those type of companies dropping that group plan and making their employees go find their own individual plan. And there is a nice FAQ out there that the IRS put out. So if you just Google FAQ IRS ICHRA, it should be your first one that pops up. And that is, honestly, I think it's like a 7-page FAQ. And then it actually has the model attestation notices. It does not have a plan document. You're going to have to go to an attorney and get that plan document written, but you could use those attestation and model notices. Remember that model notice has to go out 90 days prior to your employees, and then those attestation statements, there's an annual one, and then there's that ongoing one when the employee wants that reimbursement of those funds. Those are the model notices that you can find in that FAQ. You'll have to switch it up a little bit for your specific situation. So next polling question: unlike the QSERA, with an ICHRA, the employer can offer an FSA. True or false? Okay, so the answer is true. You can still have an FSA if you have an ICHRA. So like I said earlier, the ICHRA works perfect, in my opinion, for avoiding that pay or play mandate, especially the 4980HA penalty, which we'll talk about those penalties in a minute. If you remember correctly, that A penalty is the penalty that if you don't offer insurance to substantially all of your full-time employees, that substantially all is that 95% test. Then if one employee goes to the exchange, it will trigger a penalty on all of your employees. That's the A penalty. If the ICHRA is deemed affordable, you're also going to avoid the 4980HB penalty. Those are the two pay or play penalties that we'll talk about in a minute. Affordability is based on the lowest cost silver plan in the exchange, with the exchange where the employee lives. There's some proposed guidance that we'll talk about in a minute that deals with this. If affordable, then it's deemed to meet minimum value. So then we would avoid the 4980HB penalty. You can use one of the 3 safe harbors below, similar to any other group insurance plan. You cannot receive a premium tax credit if you take the ICHRA, or if you waive the ICHRA and the ICHRA is deemed affordable. So if I'm an employee and I get my insurance off of the exchange, here in Minnesota, obviously that's MNsure. A lot of states default to the federal exchange. If I do that and I take that ICHRA, and let's say that ICHRA is only $100 per year, I am no longer eligible to get that premium tax credit, regardless if that $100 is deemed affordable or not. If I say thanks, but no thanks, employer, and I waive that ICHRA coverage, and that is not deemed affordable to me, then I can get the premium tax credit from the exchange. So let's go through an example of how that affordability works. So let's say Sam earns $50,000 a year. The lowest cost silver plan for Sam on the exchange is $950 a month, and the employer gives him $500 into the ICHRA every month. Is that ICHRA deemed affordable? Well, we take the $50,000 times the affordability percentage for 2020, because remember, this rule comes into effect in 2020, and we divide that out by 12. So Sam can afford $407.50. Well, the premiums on the exchange in this example were $950. We get $500 in the ICHRA. So Sam would have to pay $450 a month for his coverage. So since that's greater than the $407.50, that ICHRA is not deemed affordable. Therefore, if Sam would say thanks, but no thanks to his employer and waive this ICHRA, he could get a premium tax credit on the exchange if he would otherwise qualify. There are some, these are called EBRAs, they're accepted benefit HRAs. These are new as well. These came out the same time the ICHRAs came out. I don't really see a benefit to these, to be quite honest with you. You must have or offer group insurance. You don't have to take the group insurance in order to get this from your employer. Again, it's provided with employer funds only, and it can reimburse for medical expenses, premiums for vision, dental insurance, etc. So there were some proposed rules on the ICHRAs and the employer mandate as far as how do we know if that's affordable. We're just going to kind of go through this real quick, just in an effort to get through the entire seminar. And then if you have questions on this, you can by all means send me an email. But the lowest cost plan, so we can use the lowest cost plan. So you'd always want to look at that silver plan on the exchange. Remember, we have the different metallic plans on the exchange. You look at the lowest cost plan for the lowest age band in your group, and then that's the silver plan you can use for all of your employees. Of course, you'd have to look at their age as well. That just helps employers so they don't have to go to the exchange, see what the lowest cost silver plan is for every single plan offered for every single individual in that age bracket. Location safe harbor, so you could use your where the employee's place of employment is. Now, I do think this is a good safe harbor, if you will, because if I have employees that are in varying zip codes, I would have to otherwise look at their different zip codes. Now I can just look at the location where they're working. Excuse me, the affordability safe harbor, same as traditional groups. The look back safe harbor, how do we know what cost we can use? Well, for calendar year plans, we can use the cost for January of the previous year. For those fiscal year plans, we can use the cost for January of the current year. So now we're going to talk a little bit about the pay or play penalties. Now, this is old news, so to speak, because this rule has not changed. We did hear a lot of comments out there how they thought that 50 numbers should be brought up to 100. Nothing's going to be done. If you have 50 full-time equivalent employees, you are a large employer. Now remember that 50 number is always based on prior year hours, and it's calendar hours. So you would look at your 2018 hours to know if you're an ALE for 2019. And it's based on calendar hours, and it's based on 120 hours per month, not the 130 hours a month that we use once you are an ALE to determine if you're a full-time employee. Two different hour thresholds there. There's no different rules for profits or nonprofits. The rule's the same. So we're going to talk a little bit about the two penalties. We talked earlier about the A penalty and the B penalty. So the A penalty, that is $2,500, and that's for 2019. It's $2,500 per full-time employee. Now you get to have 30 employees free. So it does not matter if you have 100 employees or 1,000 employees. Each employer gets 30 free employees. So if I had 100 employees and one of those, and I didn't offer substantially all of the employees minimum essential coverage, and one employee goes to the exchange, I would be hit with that $2,500 penalty on 70 employees. Now the 4980HB penalty is the nicer of the two penalties, even though it's a higher dollar amount, because that penalty only goes to the employer, or gets assessed to the employer, for each employee that goes to the exchange and receives a premium tax credit. And it's maxed out at the 4980HA penalty. So again, if I had those 100 employees, I wouldn't pay $37.50 on each one of those employees, because it would get maxed out by the A penalty. So here is the calculation for how that works. Now, if you are one of the unlucky ones that received a notice from the IRS, you will see that they give you a nice little chart to break this penalty down per month. What we should note, though, is if anyone on the call is part of a controlled group, the program that the IRS uses to calculate that penalty is not correct unless you have the exact same number of employees in each of those controlled group entities. So you will have to write the IRS, show it on an Excel spreadsheet, because that 30 free employees gets prorated according to how many full-time employees work there, and that's the portion that the IRS is getting wrong. We've asked them to correct their computer programming, and they won't, but they will adjust your penalty based off the rules if you write them. So large employers that offer unaffordable insurance, or insurance that doesn't meet the adequate test, meaning that minimum value test, then if one of those employees goes to the exchange and receives a premium tax credit, you would be hit with that $37.50. Now, I should say that, remember, anytime someone takes coverage with you, technically they're not supposed to be able to get a premium tax credit on the exchange. We have had that done. We've seen employers come to us and say, listen, little Johnny took our insurance and he went to the exchange. We got a notice from the exchange that he qualified for a premium tax credit. So then what will typically happen is it will go over and go through a judge review, and you'll be able to submit documentation and get the problem fixed at that point. So affordability safe harbors. That safe harbor percentage for 2019 is now up to 9.8%. So your 3 safe harbors, same as what they've always been. It's box 1 of your wages. Remember, that takes into account your pre-tax items. So if you have somebody putting a lot of funds away into their 401k, it is going to bring down their wages, which could hurt the affordability, obviously. Health insurance, if that's pre-taxed, yes, that would affect affordability. But remember, if you take insurance, you don't care so much about the affordability because it doesn't matter. They took the insurance. You don't have to worry about if it's affordable or not. The rate of pay, that rate of pay, what I see being done wrong on here is people will use their rate of pay even if they get a raise or if they work 200 hours a month. That rate of pay is the rate of pay at the beginning of the plan year. Increases are not looked at, but decreases would be looked at. So if your employee, for some odd reason, got a decrease in February, you have to recalculate that affordability for the month of February then. Federal poverty line, you do use that 2018 amount with the 19 affordability percentage. If you are one of those employers who are using that 1A qualified offer code because you're using the federal poverty line, meaning you are you're paying quite a bit for your employee's insurance. That dollar threshold for 2019 is $99.75. Remember, for 18 it was $96.08. So if your employee is paying less than that amount, then you have an easier filing because if you have a qualified offer, and you can just tell the IRS on that 1095-C that they have a qualified offer and you don't need to worry about those safe harbors. Watch out for plans that meet minimum essential coverage and not minimum value. We see these every now and again, and they do cause some substantial penalties. The safe harbor goes down next year to 9.78. What this means is since it decreases from the 9.86 to the 9.78, you're going to have to adjust those employee wages higher or their premiums for self-only coverage lower if you're right on that borderline of being affordable. If that plan doesn't meet minimum value, you are not allowed to put a safe harbor code in on your 1095-C. Most plans that we see do meet minimum value, so probably they do. If you look on your SBC, your summary of benefits and coverage, it should be on page 6 or 7 of most of the summary of most of those SBCs, and it will say whether your plan met minimum value. The prior year safe harbor percentage is 9.56. Why I put this in there, because remember, if you have a fiscal plan year, you're going to use 9.56 for the months in your 2018 plan, and then you're going to use that 9.86 safe harbor percentage for the months coming into your 2019 plan year. So this is one of the one of the spots that I see a lot of issues, and this is that substantially all test that we have talked about a couple times earlier in the presentation. So what this says is it says if 95% of your full-time employees are not offered minimum essential coverage, it's as if no one was offered. And this is a big reason a lot of companies have decided to use that look-back measurement method versus the monthly measurement method. And we'll talk about those in a minute, but the basis of those are if you use the monthly, if you work 130 hours that month, you're deemed full-time. If you work under, you're deemed part-time. Well, you never know till the end of the month how many hours you're going to work. That method was meant to be for those employers that have full-time employees and part-time employees, no variable hour employees, meaning no employees that their hours vary up and down. The look back looks back over a period typically of 12 months, and it says, all right, if I take 130 times 12 months, that's 1,560. If someone works 1,560, then they're deemed full-time for the next period. So if you've got a lot of those variable hour employees, the look back is nice because we don't want to trip this 95% test. If you go out to our website and pull up that article, Two Unlikely Cousins, it's a tough read, but it's a good read. And it's not very long, but the rules are a little bit complicated, but it will explain why there's a benefit to using the look back versus the monthly. Because let's just take this one step further. Let's say I have 100 employees, and let's say the Excel spreadsheets that I was using, or maybe I'm using a payroll software, but I didn't enter the information correctly. Remember, the output's only as good as the input. So if I mis-enter something and I have 100 employees that are full-time, but I think that I only have 94. So I offered 94 employees insurance. And let's just say I pay 100% of the employee premium. I think I'm okay. I think I've done what I should do. And one of those employees who didn't take that insurance goes to the exchange and receives a premium tax credit. I am now going to be hit with a penalty on all 100 employees minus 30 times $2,500. So on those 70 employees, I'm going to pay a $2,500 penalty on each of them. Plus, I would have paid for insurance for 94 of those employees as well. So you're going to want to make sure you're looking at that. I always tell employers, don't use that 5% cushion. It's a cushion. It's not meant to be purposely used. Otherwise, you could trip that pretty easily. Now, a lot of clients will say, Tanya, I don't know if they're going to be a full-time employee or how I should classify them. Well, classify them as they should be classified, because in a perfect world, we'd classify everybody as part-time or variable, and we wouldn't offer them insurance until they've completed their look back. But you can't do that. So if a full-time employee is replacing a full-time employee, or it's expected that they're going to work at least 30 hours a week, how did you advertise for that job? Who are they taking over for that position? All of those are things that you should consider. There's not one bright line test. If you're a full-time employee, you need to offer them insurance after your waiting period not to exceed 90 days. So polling question number 3, what will be the new safe harbor percentage rate in 2020? 9.78% is the correct dollar amount. So if you're unsure on those full-time employees, you can put them into that look-back measurement method and then see what they work after that. So we talked a little bit about this slide already, the monthly versus the look-back. I want to get to that look-back so we can understand how that works. The monthly is pretty basic. So when you use a look-back, you're going to put everybody in a measurement period. Everybody obviously doesn't start on the same day every year, so they wouldn't start on the first day of that standard measurement period. So those new employees for the first year of hire are going to have their initial measurement period. It's important to note that full-time employees will always be measured monthly until they complete one full SMP. Only variable and part-time and seasonal employees get an IMP. Excuse me. So the standard measurement period, that is what you're going to look at year after year after year to see which employees are hitting that full-time hours requirement. Now, you can offer part-time employees insurance, but if they're not meeting that hours requirement and you're not self-funded, you don't want to give them a 1095-C form. Every form you put out is a potential penalty coming back in. So there's a fine line on how many forms to put out. So I'm going to go right to our chart here, and I'm going to explain this example. And I'm going to skip over the prior slides, but read through them. Again, none of that information is new, so it shouldn't be a surprise, but if you have questions, please let me know. So why I would like to look at this chart is because there's several instances in the ACA where I like to say the employee always wins. This is one of them. And to explain that, let's go through and say, okay, in that initial measurement period, Carter was hired on August 1st of 16. He works 12 months. This employer, by the way, is using a 12-month measurement period. He works 12 months and he hits 1560 hours. So he has to be classified as a full-time employee in the stability period associated with the initial measurement period. So 9/1 of 17 through 8/31 of 18, he needs an offer of coverage. Now let's say in the stability period, the first SMP from 6/1 of 17 to 5/31 of 18, he only works 1,400 hours. He does not need to be offered coverage in the following stability period. However, I can't drop his coverage until 9/1 of 18. I don't get to do it on 7/1 of 18 because remember, he was full-time in the stability period associated with the initial measurement period. Now let's flip that around. Let's say in the initial measurement period, he works 1,400 hours. I don't have to offer him insurance in the stability period associated with the initial measurement period, meaning September 1st of 17 through August 31st of 18. But now let's say he works full-time in that first standard measurement period. So he works, let's say, 1,600 hours in the SMP. Now I do have to back up that offer to 7/1 of 18. I do not get to wait until 9/1 of 18. Again, one of those instances in the ACA where the employee always wins. Hours of service, remember to include any hours that they're paid for. So if they have some vacation time, you have to include that. Now, if you're using the look back and you have someone on a special unpaid leave, meaning FMLA, military, or jury duty, and let's say that I am on FMLA for 2 months and I'm in my look back period, you only get to use those 10 months for that measurement period. So you take 10 months times 130 hours. If I hit 1,300 hours, then I would be full-time in that following stability period. So in other words, that special unpaid leave, you just take that out of the equation and take the remaining months of your look back times the hours threshold, 130 hours a month. So this is another important overlooked rule. So employees that are rehired. So if I am rehired within 13 weeks, 26 if you're some sort of an educational institution, such as a college or a high school. But if I'm not an educational institution, that rule is 13 weeks. If you hire me back within 13 weeks, and I was a full-time employee when I left, I come back as a full-time employee. You can't rehire me as a part-time employee. So you need to offer me coverage as soon as the rules say, as soon as administratively possible. The next sentence line goes on to say the first of the following month is deemed as soon as administratively possible. Now, when someone is full-time and they're locked in that stability period, like Carter was locked in his stability period because of the hours he worked in the prior look-back period, they are technically locked in that stability period. However, there is a caveat in the regulations that say, if I take a part-time position when I'm in that stability period, and if I was offered insurance that met minimum value when I was first hired, obviously after my waiting period, and if I average under 30 hours a week for 3 full consecutive months, on the first day of the 4th month, you can call me a part-time employee. That's a lot of words. Let's go through an example of how that works. So let's say on April 15th, I go to my employer and say, I want to work part-time, and I'm able to work part-time. So the employer says, okay, I can't count April because that's not a full month. May, June, July. If I average under 30 hours a week for those 3 months, May, June, July, then August 1st, the employer can drop my offer of coverage and start calling me part-time. And then they'd measure me monthly until I complete one full SMP thereafter. Now, some employers will say, well, Tanya, I offer COBRA coverage once they drop down to part-time. The problem is that COBRA coverage isn't always affordable. Now, remember, you only have those 3 months that you have to worry about the affordability penalty. And then remember, if they take coverage, so if I take that COBRA coverage, you don't care about the affordability because I can't go to the exchange and receive a premium tax credit. So now we're going to talk a little bit about the notices that we're seeing out there. Still seeing some notices for 16. I just got one yesterday. Actually, it was completing the notice response, so that one's being closed out. So most of the 16 should be being closed out this month and next month, and then we'll have 17, and I'm assuming they're going to start looking at 18 pretty soon. Most of the notices that we see are from clients preparing their forms incorrectly. We talk about it a little bit later. I have a slide in here, but if you read the Accounting Today magazine, there was an article on August 7th saying, you know, do some risk assessment on these forms. The IRS is coming down a little bit harder on them. You should have your forms reviewed. If you are not 100% sure if your forms are correct, get them reviewed. It's easier to correct those forms, or it's easier to have them reviewed before you even submit them to the IRS. Have them reviewed. It's easier to fix them than to go through the process of getting one of these notices. Like I mentioned, the 2017 notices are coming out. Penalties, we've seen penalties, we've seen small penalties, you know, only about 10,000, and we've seen some very large penalties, way over $1 million. So depending on how you're filling those out, obviously depending on how many full-time employees you have will be dependent on what that notice is. Those notices are due within 30 days unless you get an extension. There's also another notice coming out called a 5699. And what that is that's a notice coming out to employers saying, hey, we think you might be an applicable large employer and we don't see any forms. So they're missing your 1094 and 1095C forms. So you have 30 days to respond. I'll tell you what a lot of clients are getting this notice from, because they think their insurance companies are filing the forms, so they've just never filed forms. That is incorrect. Any type of industry you're in, if you're a large employer, you have forms to file. The insurance companies will not file the forms for you. They are filing the forms for the insurance company, so they're filing because you're fully insured, and they're doing the 1095B forms. You, as a large employer, have to file the 1095C forms. Remember, if you've calculated your status and you're not an ALE, keep track of that. That's always based on the prior year, remember. And if you're not an ALE, just keep record of how you did that calculation in case you get one of these notices. Remember, if you have over 250 forms and you get this notice and you start filing your forms, you do still have to e-file. We've asked the IRS before if they can make some kind of waiver for this rule for prior year forms, as there's a lot of companies out there that won't allow their software to upload prior year forms. Unfortunately, there's no getting out of it. You have to e-file them or you will get a penalty for that. We talked a little bit earlier about the 972CG notices. Those are the notices that have just started coming out this year for the ACA forms. They're coming out because you're filing the forms late, or they think you're filing the forms late, or you're filing the forms on paper and not e-filing them when you should have been filing them electronically. We talked about the misconception that insurance companies are filing those forms. They are not. Companies that are self-funded, but they're not large employers. So maybe I have 40 full-time equivalent employees, but I have a self-funded plan. I file that on the 1095B forms. If I'm self-funded, remember those 1095C forms have to fill out Part 3. That has not changed, even though the individual mandate is gone. And companies that are not ALEs and are not self-funded don't need to file any forms. Remember the controlled group rules, however, that could pull you in. We're going to go through some of these, what I see on errors. I did list them after this, but I think it's easier if we go through what I see in errors while we're looking at this form. So the biggest errors I see on this 1094C is I see people not putting line 18 and line 20. They should be the same number of forms that you're filing, unless you're allowing different divisions within the same company to file their own forms. I do have some clients that are doing that, but unless you're a very large entity, you're not going to do that. And you would have the same number of forms on line 18 and on line 20. Certifications of eligibility, I see people just skipping over this line. You're supposed to check all that apply. So if you're using that 1A code that we talked about before, and someone has that 1A offer all 12 months, check line 22A. If you're offering affordable coverage to 98% of your full-time employees, check 22D. The benefits to checking 22D are on column B on page 2, you don't need to fill this in. Now, the most important box of any of these ACA forms, both the transmittal and the actual 1095C form, is line 23A. That's what's causing the most notices out there. If you offer a plan and it's offered to 95% of your full-time employees for all 12 months, check box 23A. Another thing I see being done wrong here is you don't fill out all 13 rows. You either check the all 12 months box or each individual month. All employers have to fill out column C. Again, if you have got the same number of employees every single month of the year, you can use line 23C. Otherwise, each individual month should be filled out. Column B needs to be filled out if you're not checking 22D on that first page. There's the common errors that we just discussed. Remember, if you're part of a controlled group, your other related entities go on page 3 of that 1094C. Didn't put that on the slide. It's not applicable to everybody, but what you need to remember is they go in order of descending order, greatest to least, according to full-time employees. 1095C, I know most of you are probably thinking this is the fun form. Remember, if you are doing this form, row 14 has to have something in it for each month, or the all 12 months box. In each 14, 15, and 16, you only enter at maximum 12 boxes. You don't enter all 12 months and each box. So line 14 always has to have something in for each month, or the all 12 months box. Line 15, if you're entering the dollar amount of the premiums for self-only coverage because you have to, remember to put your cents in there. So if it's $100, it's 100.00. Line 16, if you don't fill this out, you're open for penalties unless you're using a 1A code or a 1G code. So think about your safe harbor as your excuse code. Why did you offer or not offer? What is your reasoning? So right there are some items we just went over. Common coding. Nothing's changed from prior years. It's just a review, other than the dollar thresholds have gone up due to the affordability percentages that have gone up. So again, all of these codes are same as what it was. 1G code. Here's what I see being done often incorrectly on that. A 1G code, that's only being used for companies that have self-funded plans. And a 1G code is used for all 12 months, no exceptions. You can't use it for only certain months of the year. It's used for all 12 months. And what that code means is it means this person was never a full-time employee for any month of the year. Maybe it's your board of directors. Maybe it's someone who's working part-time for you, but they took your coverage. And since you're self-funded, you have to give them the form to report what months they had coverage. Maybe it's someone on COBRA continuation coverage. They quit working for you in 2018, but they're still on your plan in 2019, and you're self-funded, so you need to give them the information down in part 3. So here are some common misconceptions. Only ALEs need to file 1094 and 1095 forms. That's not true. If you're self-funded, you have a reporting requirement. Only employees who enroll in coverage need that 1095C form. No, they don't. All full-time employees need that 1095C form. Insurance companies file 1095C forms. I've been doing this for Well, I've been working with the ACA since 2010. This is our fourth year doing these forms, and we've never had an insurance company do these forms for the employers. Payroll companies automatically file ACA forms. Not true. There's a separate module you often have to purchase. Remember, if you're doing these, the software could work correctly, but if the input isn't done correctly, the output's going to be incorrect. All payroll companies have ACA experts. That's not necessarily true. After 2018, there's no ACA forms to be filed due to the individual mandate being repealed. Again, that is false. Seasonal workers do not need a form. If they trip the full-time requirement, they would need a form. No need to print off forms if a payroll company prepares them, as long as you keep that payroll software. That's not true. When they update the payroll software, the prior year forms often update. Now, when you get an IRS notice, we have a hard time seeing what was actually filed with the IRS originally. Print those forms off or put them on a PDF on your computer. Can reimburse for individual health insurance premiums as long as the employer is not an ALE. That is untrue. So you cannot do that. True or false? Last polling question. Only ALEs need to file a 1094, 1095C form.
All right, we're going to go ahead and close this poll and hear the results.
Okay, the answer is false. If you have a self-funded plan, you do have some 1094 and 1095C forms to file. So now, Amy, I'll take any questions if there was any in the chat box. Otherwise, they can email me at this email address and I will respond to them.
Okay, well, there's nothing in the chat box or the question box right now.
Okay, perfect. All right, so thank you everyone for joining our webinar. Thank you, Amy, as always, for helping us with this webinar. And let me know if you have any questions, everyone.
Awesome. Thank you all so much, and you have a great day.